Welcome to Financial Freedom FX. Today, we are going to talk about an intraday trading strategy, and I'll explain it to you in a very detailed and simple way, so you can easily understand and apply it in your own trading. When we look at this USD CAD chart, the first thing to notice is how the price keeps moving in waves. It goes up for a while, then down, then up again. This movement is what intraday traders try to capture. The idea is not to predict the entire big trend, but to use these up and down moves within a single day to make small, consistent profits. A good strategy here is to identify where the price has turned around before. Those points act like zones, where the market often reacts again. If the price is near a zone where it bounced back in the past, that's a possible buying opportunity. If it is near a level where it was rejected earlier, that's a possible selling opportunity. Now, the important part of an intraday strategy is entry and exit. Many traders make the mistake of only focusing on the entry, but the exit is where the money is actually made. If you are planning to buy, you wait until the price confirms strength, meaning the candles are showing upward momentum and the price is holding above recent levels. Once you are in the trade, you must decide in advance where you will exit for profit. For example, you can target the next area where price struggled in the past. At the same time, you also fix a stop loss below the recent turning point, so that if the market goes against you, you lose only a small controlled amount. The same principle applies if you are selling. If price has already moved up a lot and reaches a resistance zone where it has reversed earlier, you can look for signs of weakness to enter a short position. Again, your target will be the next support zone below, and your stop loss should be just above the recent high. This way, whether the market goes in your favor or against you, your risk and reward are clearly planned. Another key element of this strategy is discipline. The market gives plenty of signals in a day, but you don't need to take every single one. The smart approach is to wait patiently for high-quality setups near the important zones and then trade only when your entry and exit conditions are met. This helps reduce emotional decisions and avoids overtrading, which is the #1 reason many intraday traders fail. Finally, risk management is the heart of the strategy. No matter how good a setup looks, never risk more than a small percentage of your account on one trade. A simple rule is to risk 1 to 2% per trade, so that even if you lose a few trades in a row, your account remains safe. With consistency, even small daily profits can add up to a significant gain over weeks and months. When we shift from the daily chart to the 4-hour chart, we start to see the market structure more clearly. Each swing up and down shows us how buyers and sellers are fighting for control. In intraday trading, this time frame is very useful because it helps us spot short-term opportunities without too much noise. On this chart, we can see that after a long period of choppy movement, the price started forming higher lows, meaning buyers are stepping in earlier each time. At the same time, we can see higher highs forming, which signals that momentum is shifting toward the bullish side. A good intraday strategy here is to follow the trend by using these higher lows as a guide. When price pulls back and touches a zone near the previous support area, traders can look for confirmation signals to enter a buy. The advantage of this approach is that you are trading in the direction of the bigger momentum rather than trying to fight it. For exits, the next resistance zone or previous high becomes your target. This way, the market itself is guiding you where to enter and where to exit. The opposite also applies. If price moves sharply up and reaches a resistance zone where it reversed earlier, short-term traders can plan a sell setup if there are signs of weakness. In this case, your target will be the next support zone below, and your stop loss will be just above the recent peak. This strategy is simple yet powerful because you are not guessing. You are reacting to how the price has already behaved before. Risk management on the 4-hour chart is very important, since the candles cover a bigger move than a 15-minute or 5-minute chart. Your stop losses should also be placed sensibly, not too tight. The goal is to allow the trade some breathing room, but still keep the risk controlled by adjusting your lot size. A small, consistent profit from following this method regularly is always better than chasing big, risky moves. In the end, this chart reminds us that intraday trading is not about predicting every tick. It is about identifying where the market is showing strength or weakness and then placing trades with clear rules. Enter near support or resistance, set a proper stop loss, and exit at the next logical level. If followed with discipline, this strategy can make intraday trading less stressful and more consistent. On the 1-hour chart, the price action becomes sharper and gives a closer look at how intraday momentum is building. Here we can clearly see that after a long period of sideways and choppy trading, the market has recently picked up strength and is moving higher with strong bullish candles. For intraday traders, this is a very important signal because it tells us that buyers are dominating in the short term. The key here is not to rush into trades, but to wait for pullbacks, because markets never move in a straight line. When price retraces slightly and comes back toward a recent support zone or an area where strong buying previously started, that becomes a potential entry point. Another useful strategy on the 1-hour chart is to focus on breakouts. Since intraday trading relies heavily on momentum, if the price breaks above a recent resistance level with a strong candle, it usually continues in that direction for some time. Traders can take advantage of these breakout moves by entering right after the breakout and targeting the next resistance above. Similarly, if the price fails to hold above a breakout and reverses, that gives a chance for a short trade back down to the nearest support. The 1-hour chart also allows traders to define tight stop losses, which is critical in intraday trading. Instead of keeping very wide stops, you can place your stop just below the support in a buy trade or just above the resistance in a sell trade. This keeps the risk small and the reward-to-risk ratio favorable. The beauty of this time frame is that even a 30-40 pip move can be captured quickly if you enter in sync with momentum. In short, the H1 chart shows us that intraday trading is about timing. You don't need to predict the entire day. You just need to ride 1 or 2 strong moves. Wait for pullbacks or breakouts, trade with the dominant momentum, and always protect your capital with disciplined stop losses. This combination of patience and discipline can turn the 1-hour chart into one of the most reliable tools for intraday traders.